Prepare yourself, the photovoltaic industry might face even tougher times in July and August. Insiders predict that after the Shanghai Photovoltaic Expo, component prices might drop to 0.6 yuan per watt. And this is not just a scare tactic. The current state of the photovoltaic industry is dire, with domestic power consumption being dismal, ground power station purchases lagging, and expectations for distributed electricity market transactions seriously damaging investor enthusiasm for full internet access. Residential photovoltaic systems are already dealing with the fallout. Meanwhile, Europeans will be on summer vacation in July and August, making the overseas market even tougher. The delisting of Zhejiang Acom New Energy Technology is just the beginning. Many photovoltaic companies, including leading ones, may not withstand the freezing market conditions. The second and third quarters have been extremely challenging for the photovoltaic sector.
This man mentioned that the photovoltaic industry has faced multiple challenges in the second and third quarters, including severe domestic power consumption issues and disappointing ground power station purchases, all of which have significantly impacted the industry's development and the operations of companies. The problems are expected to worsen in July and August, with further declines in component prices anticipated.
我在光伏板块持仓半年，亏了100万。
I lost 1 million yuan in the photovoltaic sector over 6 months. If you're stuck in photovoltaic stocks or thinking about buying in, watch this video. This morning's drop reminds me of last July's painful lesson. Back in March, I warned everyone to sell off photovoltaic stocks because a drop was coming. From the 12th to now, individual stocks have fallen nearly 20 points. With over 5,000 companies in the market, it's impossible to understand each one thoroughly. My significant losses in the photovoltaic sector gives me some authority on this matter. Beyond technical analysis, sometimes intuition about the sector is more important. The photovoltaic sector tried to rebound in July last year and January this year, but failed both times.
This man, who has experienced losses in the photovoltaic sector, predicted in March that the market would decline and advised everyone to sell off their stocks. This prediction proved accurate, as photovoltaic stocks have dropped significantly. The Chinese government has ignored weak domestic demand and continued to expand industrial capacity without taking measures to stimulate new demand. This has led to many countries refusing to import China's cheaply exported products due to overcapacity, leaving Chinese manufacturers struggling in the domestic market. The Wall Street Journal reported on July 22nd that about a quarter of Chinese-listed companies are now losing money, compared to just 7% 10 years ago. For example, Jiangsu Lopal Tech, which supplies lithium iron phosphate for making power batteries, reported a loss of $169 million in 2023, wiping out profits from the past 3 years. The company blamed overcapacity in the Chinese lithium iron phosphate market and a slowdown in demand from domestic battery manufacturers. Jiangsu Lopal Tech has continued to incur losses this year. The company expects a net loss of 248 million to 313 million yuan in the first half of the year, not including non-recurring losses. The report noted that Chinese companies are struggling due to severe overcapacity and weak consumption, pushing many to the brink of collapse, forcing significant price cuts and profit reductions. According to Chinese media reports, LONGi Green Energy, a solar module manufacturer, announced on July 9th that it expects a net loss of 4.8 to 5.5 billion yuan for the first half of 2024. LONGi Green Energy stated that it has increased its investment in products and services in the photovoltaic terminal market. This led to a year-on-year increase in component sales. However, the overall supply-demand mismatch in the photovoltaic industry and the sharp decline in market sales prices of major products have still led to loss. On the same day, Ansteel Group also announced its performance forecast, expecting a net profit loss of 2.7 billion yuan for the first half of 2024. The main reasons are the continued weak market conditions in the steel industry, overall industry losses, weak downstream demand, and low steel prices. The Wall Street Journal reported that with the bursting of the real estate bubble that had driven economic growth for many years, the Chinese government has been investing in manufacturing, but has taken few significant measures to stimulate consumption and absorb the resulting supply. At a press conference on July 19th, Chinese officials stated that to address the real estate slowdown, Beijing will accelerate the development of emerging and future industries such as electric vehicles and solar energy. The resulting overcapacity has caused producer prices to plummet over the past 2 years. This is dragging the overall economy to severe deflation and eroding corporate profits. In 2023, a Goldman Sachs analysis found that the three main industries prioritized by the Chinese government, electric vehicles, lithium-ion batteries, and renewable energy, make up only about 3.5% of China's GDP. They also failed to create enough jobs for millions of struggling college graduates and migrant workers. Mary Gallagher from the University of Michigan said in her latest research that from the Great Leap Forward to the Chinese real estate boom, overcapacity is part of the Chinese government's broader governance model, which tends towards overproduction and exceeding targets. The Wall Street Journal reported that to make up for weak domestic sales, Chinese companies have turned to exports. Data shows that China's exports in June grew by 8.6% year-on-year. However, these exports put pressure on jobs and industries in other countries, reminiscent of the China shock about 25 years ago. At that time, China's entry into the global trade system squeezed out manufacturers in countries like the US that produced toys, clothing, furniture, and other labor-intensive products. Consequently, trade barriers against China are increasing. Former U.S. President Donald Trump had proposed a 60% tariff on all Chinese goods. Recently, the European Union announced it would raise tariffs on Chinese-made electric vehicles. India, Brazil, and Turkey are also implementing restrictions and anti-dumping investigations to counter Chinese imports. Logan Wright, a partner at Rhodium Group and the head of the company's China market research, said, "An investment-led growth model can only go so far because ultimately there has to be demand somewhere. There will be a reckoning within China." Many economists believe that overcapacity is an inevitable result of China's economic system. The Chinese government often directs capital to favored industries through subsidies, tax breaks, state-owned banks, and investment funds. A new study by the Kiel Institute for the World Economy in Germany found that as part of Beijing's push for dominance in electric vehicles and other clean technologies, Chinese automaker BYD received at least 3.4 billion euros, about $3.7 billion US dollars, in direct government subsidies. Dirk Dosey, one of the co-authors of the report, pointed out that government subsidies are very common in China. In 2022, over 99% of listed companies received direct government subsidies. The Chinese government often uses subsidies strategically to advance key technologies in the market. The New York Times reported that more than 100 factories in China can produce nearly 40 million gas vehicles each year, twice the number that Chinese people want to buy. The Wall Street Journal believes that overcapacity in China will eventually lead to corporate defaults and bankruptcies. While some Chinese companies are seeking markets globally, investing overseas, or enduring greater losses, by continuing to sell to countries that require tariffs, this limits their ability to invest in new products, raise wages, or hire new employees in China. Louise Liu, chief China economist at Oxford Economics, said that by increasing supply, causing a supply-demand imbalance, the Chinese government is creating today's growth at the expense of tomorrow's. She said, "Whatever you produce now, you won't produce in the future." According to a report by Cailian Press, as of the evening of July 9th, among the companies that disclosed performance forecasts, 305 companies expected profits, while 393 companies expected losses. The photovoltaic industry was one of the hardest-hit sectors in the first half of the year due to the overall decline in market prices across the industrial chain and maintaining low levels. It was also the sector with the most companies forecasting huge losses on that day. 7 companies, including Longji Green Energy, Tongwei Company, TCL Zhonghuan, Ico Solar, Shuanglian Eco Energy, Jingyuntong Technology, and Hongyuan Green Energy, expected losses of over 1 billion yuan. Data shows that in 2023, China's new 3 of new energy vehicles, lithium batteries, and photovoltaic products collectively exported 1.06 trillion yuan, surpassing the trillion yuan mark for the first time, growing nearly 30%. However, after just 6 months, many photovoltaic companies are already experiencing continuous losses. U.S.-based financial scholar Cheng Xiaonong told Radio Free Asia that in the past, local enterprises in China used central government subsidies to develop in the photovoltaic industry with the goal of exporting. But now, with the increasing difficulty in exports, it is harder to enter the U.S. market, and the EU is discussing anti-dumping sanctions. It was inevitable for the photovoltaic industry to fall into losses. This issue is not limited to the photovoltaic industry, but also affects electric vehicles. Cheng Xiaonong said, China originally hoped that electric vehicles would dominate the European market, believing they could defeat all European automakers and monopolize the market. But European countries are not foolish. They will not allow China to destroy them. China's so-called new three productive forces are futile, especially with the ongoing Sino-US Cold War. Years ago, it was chips. These past 2 years, it's been electric vehicles and photovoltaics. Who knows what industry they'll target next? Overcapacity is the norm in China. According to the Securities Times, on July 9th, the Chinese Ministry of Industry and Information Technology issued the Photovoltaic Manufacturing Industry Standards for 2024, guiding photovoltaic companies to reduce projects that simply expand capacity. Instead, they are encouraged to focus on technological innovation, improve product quality, and lower production costs. Industry experts suggest that China's photovoltaic industry urgently needs both the visible hand of the government and the invisible hand of the market. Structural adjustments, primarily through raising technical standards and market entry thresholds, are essential. Executive Director of the Taiwan Inspirational Association, Lai Rongwei, analyzed that China's economy has long followed a herd mentality, with corporate investments aligning with policy directions. When there's a directive to develop photovoltaics or chips, everyone rushes to do the same, resulting in high homogeneity and poor quality. He said, currently, the domestic economy in China is not doing well, and consumer desire is low. Exports face protests against cheap dumping from other countries, using unfair economic means to compete with countries that value free market principles. This has led to global backlash, so Chinese products end up being sold to Belt and Road countries or third world countries. Under these circumstances, the Chinese economy is in severe decline. Additionally, on July 23rd, Shenzhen Tiandi Group announced that its stock might be delisted due to its market value staying below 300 million yuan for 19 consecutive trading days. Chinese media Yi Cai believes that even if Tiandi Group hits the limit up on the next trading day, its market value will still not exceed the 300 million yuan threshold, confirming its status as the first A-share stock to be delisted due to market value. Tiandi Group, listed on the Shenzhen Stock Exchange on April 29, 1993, primarily deals in commodity concrete. It began incurring losses in 2020 and has lost nearly 500 million yuan over 4 years. The company continues to lose money this year, with a projected loss of 80 to 100 million yuan in the first half of 2024, a decrease of nearly 60% to 99.6% compared to the same period last year. According to Yi Cai, on July 23rd, over 100 A-share listed companies have received risk warnings this year, with an increasing number of companies and delisting types. According to the latest data from Wind, as of July 23rd, apart from Tiandi, 9 other A-share stocks had total market values below 500 million yuan, including Meisheng Ecology Company, Meiji, and Boxin. Previously, Wind data shows that as of the 5,351 listed companies on the A-share market in China, 2,803 had released their 2023 performance forecasts as of February 21st. Among these, 145 were listed in 2022 and 75 in 2023. Looking at the A-share companies that have disclosed performance forecasts, there were 64 with slight reductions, 448 with first-time losses, 621 with continued losses, and 491 with expected declines, totaling 1,624 companies. This means that 57% of the companies that disclosed their forecasts expected a performance decline. Yi Cai believes that companies listed in 2022 performed below the overall level of A-share companies in 2023. These declining companies mainly come from 5 industries: electronics, biomedicine, machinery and equipment, computers, and power equipment. According to SWS Research's primary industry classification, of 109 companies listed in 2022 that expect a performance decline, 75 are from these 5 industries, accounting for 68.8% of the total. Electronics had 32 companies, accounting for 29.4%, followed by biomedicine, machinery and equipment, computers, and power equipment with 12, 11, 11, and 9 companies, respectively. Nikkei Asia reported that according to DZH data, the net profits of approximately 5,200 non-financial companies listed on the Chinese mainland in 2023 totaled 2.85 trillion yuan, a decrease of 100 billion yuan or 3% from 2022. In the first quarter of 2024, from January to March, these companies' net profits fell by 5% year-on-year. This indicates a slow recovery of corporate profits under the deflationary pressure faced by the Chinese economy. The decline in the profits of Chinese-listed companies is related to the downturn in the real estate industry. According to Southern Metropolis Daily, as of July 10th, more than 10 listed real estate companies had issued their first-half performance forecasts for 2024, all showing losses. Companies specializing in high-end real estate projects, such as Financial Street, expect a net profit loss attributable to shareholders of about 1.8 to 2.2 billion yuan in the first half of 2024. Other companies, like Overseas Chinese-Town and CCCC Real Estate, also expect losses exceeding 1 billion yuan. Vanke, which has turned from profit to loss, expects a net loss of 7 to 9 billion yuan in the first half, a year-on-year change from 171% to 191%. The Wall Street Journal reported on July 10th that the downturn in the Chinese real estate industry has persisted for years. Economic slowdown and weak consumer confidence have dragged down the sales of many real estate developers, pushing them into liquidity crises. Many developers have defaulted on loans and bonds, and some have faced bankruptcy due to difficulties in raising funds in debt markets. The Wall Street Journal previously reported that economists estimate that it will cost hundreds of billions of dollars to clear the vast backlog of empty or unfinished homes across China. They warn that given the number of unsold and unfinished houses, this national plan must be massive to be effective. In 2023, Chinese real estate companies reported a net loss of 13.5 billion yuan, marking the first loss since statistics began in 2020. Since Beijing imposed loan restrictions on the real estate industry in 2020, a series of developers have faced funding problems, leading to bankruptcies and defaults on dollar bonds, with many properties experiencing delivery delays. Nomura Securities estimates that there are still between 20 million and 30 million unfinished homes in China. The government needs to spend at least 440 billion US dollars to complete these homes and resolve the deadlock severely impacting Chinese real estate markets. Currently, both state-owned and private developers face increasingly serious credit problems. Developers like Evergrande and Country Garden, listed in Hong Kong, are seen as more strictly regulated compared to mainland-listed companies. This suggests that the real challenge in China's real estate industry might be even more severe than the data from mainland-listed companies indicate. The real estate sector and related industries account for about 30% of China's GDP. The downturn in real estate is spreading to closely related industries. In 2023, Chinese steel companies saw a 13% drop in net profits, and non-ferrous metal companies experienced a 29% decline in net profits. Additionally, the net profits of oil and chemical companies fell by 18%, and machinery manufacturers saw a 0.2% decrease in net profits. The biggest problem facing China's economy is weak consumer demand. According to Nikkei, the immediate challenge will be to address the unemployment problem among the younger generation and the negative wealth effect brought by the real estate slump before consumer spending loses momentum.